You're listening to Fund Shack. I'm Ross Butler, and today I'm joined by Cyril Demaria, Head of Private Market Strategy at Julius Baer. He's also Associate Professor at EDHEC Business School, and he's a highly respected private markets consultant who combines operational and academic knowledge. He's the author of multiple books on private equity, and he's worked as an expert for many industry bodies, including Invest Europe, ILPA, and also the European Commission. It's been a relatively quiet time in private equity in terms of deal making, exits, deals, maybe even fundraising. But it's been a much more interesting few years, I would say, with regards to the nature of fundraising and accessing new pools of capital. And in particular, the private wealth market and the trend of so-called democratisation. And private equity groups of any real scale are all looking at how they can do this. And what I wanted to ask you, though, is how real is the actual penetration versus the efforts to access this market?
It's indeed a trend, and I think it's largely driven by the fact that indeed fund managers have discovered that the traditional sources of capital, which are institutional money, are somehow going to be, let's say, constrained going forward. Unless there is a massive shift in the way institutions allocate assets, there will be a moment where they have somehow reached a certain kind of optimum. So the natural phenomenon is to go for the more challenging pools, which are private wealth, as you rightfully stated. And so it's a work in progress, because the reason why this private wealth pool for a very long time was not the priority, it's because it's much more complex, because the situations of individuals are very, very different, and their constraints and their ambitions. So you have this very heterogeneous pool of potential investors which you need to address. And the so-called democratization that you were referring to has been, let's say, an ongoing challenge. There are structures which might support access for private wealth to private markets, and one of them is the Evergreen structure. But it's not like a smooth sailing. It's a little bit more challenging, because these Evergreen structures might fit, let's say, a common denominator, but there is still quite a few adjustments to make for clients who really want to access the asset class. So it's a work in progress. There are resources allocated. You can see that the asset base of Evergreen is growing, but according to the figures that I could get from the usual suspects, it's still representing 1% to 2% of the total of assets under management in private markets.
That's much lower than I thought it would be. And you also seem quite cautious about this. So this isn't something that everyone's charging towards. It sounds like something that's quite tentative.
Yes, I mean, the figures are from Prequin, but there might be other figures which show a little bit higher level.
I'm sure you're correct.
It also, no, I don't pretend. It's just, it depends what you consider as evergreen. I have a very strict definition. They should be doing mostly or only private markets, so they shouldn't blend other assets in the product. But you're right. It's more challenging, I think, that a lot of people thought. They thought you could industrialize and roll out, and anyway, private clients would have this kind of systematic and, let's say, rigorous approach, but also which can be implemented seamlessly. And it's not that simple. So the good news is that now we have a wider pool of tools that we can use, and you can combine together. You can then somehow adjust and tailor. But it's still, for example, challenging even for a high net worth individual to access the asset class, because regardless the tool, the asset class itself doesn't scale up or down very easily. So if you have a client with a 5 million net worth, and he or she wants to allocate that to private markets to some extent, let's say 5 to 10%, right? It's not that easy. You want to diversify over time. You want to diversify strategy-wise. You want to diversify maybe industry-wise. And then you want to diversify maybe manager-wise. And now you start to have this matrix right? Where you need to combine these constraints, and simply the amount of capital might limit you. And so it's not smooth sailing, as I said. But the good news is now we start to have the tools which support some of this capital deployment, and then we need to do arbitrage. But so this is a learning process. It's a learning process for the fund managers themselves. They might have a theoretical knowledge of it, but it's different from theory to practice. It's a process also for clients. They need to get their head around it, get familiar. It's still a very strange animal, private markets. You know, they differ from the rest of the other strategies. And then it's also a working process for us because regulations are changing. We know that, for example, in the UK and Europe, you have new structures, but we still need to understand how do they work, what are the consequences. And then there is still this idea that we are connecting the source of capital, which are the clients, and then the destination, who are the fund managers and the funds. But these two worlds, as I said, communicate through us. It's also a working process for us to try to be the interface between these two worlds, right?
Is it kind of demand pull? Is there a lot of interest? I mean, obviously levels of sophistication and interest will differ, but generally speaking, is this something that, you know, people, fund managers would just want to push onto the private wealth market, and the private wealth market is bemused, or is there a lot of interest and demand?
It depends a little bit on three things. The first one is the age of the clients. Some clients would tell you, you know, I've reached a certain level in my life where maybe I don't necessarily need to focus on that unless we have a cross-generational perspective, which is fairly different then, and has a very different set of, let's say, consequences. The second is, where do they come from as individuals? Are they former entrepreneurs, or are they more like established families? What is their proximity towards entrepreneurship? Do they relate to the corporate world? Some people made their fortune in arts, for example, and maybe corporations are a little bit more remote from their day-to-day preoccupations, whereas others might simply come from this background and they know and they enjoy this world and they feel connected very, very strongly. And the third is probably how much do they want to be involved in future decisions, and how complicated will be for them the idea of allocating money, or do they want just to, you know, be hands-off or more hands-on and lean in, basically. So in that sense, there is no singular answer, and it's not even that you can draw a map and then you can allocate clients, because it's going to shift over time, and also let's say the appetite might change. For example, in an asset class, where in private markets, where you can be interested, and it will take time to see the deployment, but also the results. But also you might be less interested and it might take time to get out. So there is this inertia. And that's also something that a lot of clients don't really understand, or they don't materialize. Oh, let's put some money in a startup. Okay. But if it's a fund, which might be less risky, or a fund of fund, which might be even less risky, it's going to be a very long course, and then there will be this built-in inertia. So if you change your mind in 3 years, it's going to be very challenging to get you out, and we will have to have this management of the long tail then.
That really is what the complexity comes down to, isn't it? And I've heard you say this before, that private markets have an extra dimension. They've got a third dimension. They've got the risk, they've got the reward, but they've got the time dimension as well. And,
Indeed.
And everything that's complex about private markets pretty much just comes down to that fact. You can't just go in, have 100% exposure and then come out. The liquidity thing, I guess.
Indeed. And that's still in 2025 a dimension that a lot of people struggle to put their head around. It's like when we start to walk, right? First we crawl, and then suddenly we start to stand up, and then we learn how to walk and run. And private markets, in a way, forces you to know how to stand up, walk and run. And maybe in the traditional asset classes, you can still crawl if you want. It's a two-dimensional world. We're in a 3D world, right? And so it's very, very challenging for people who are still crawling to understand that they should run, actually, if they want to integrate private markets in their asset allocation. And a lot of tools have not been designed for that. So if you want to build an asset allocation, still today you measure the risk in a very specific way, which doesn't apply to private markets. And a big effort has been to try to bridge these two worlds. And to be honest, till today, we didn't manage. We tried, you mentioned the books, we tried for 5 years to do that with my co-authors in a book. And we had to admit ultimately that there was no easy solution. Until a lot of people will run with their asset allocation, we're going to have this discrepancy between the crawlers and the runners, basically.
Do you have a view on what type of structure you think will win with regards to private wealth? So you mentioned evergreen structures, but there are other structures as well. There are kind of semi-liquid structures, for example. Do you have a view on what's the most appropriate way to access the asset class?
It really depends on what the clients want to achieve. So, for example, closed-end funds are well designed and they have been around for a long time. So they have been challenged regularly to ultimately see that we're reverting to this structure. Closed-end funds are very good because they embed a lot of discipline. And the discipline is valuable for a lot of investors, in particular getting the cash back. So the clients who want to get this discipline and want to have this rendezvous of getting back the cash and then make a decision again. For them, I don't think anything else is going to replace that. But the ones who are a little bit more comfortable with, I don't need this rendezvous, I have a little bit more of a different approach, which is operational simplicity, then the other tools might be a little bit more, let's say, adapted. So it's not about winning. It's more about the new equilibrium. And you could combine, for example, evergreen with closed-end fund. It really depends what you want to achieve as a client, as an investor, as a capital provider, and then how you're going to organize your toolbox. And each toolbox will be slightly different. And I think that's one of the major evolution, because evergreen funds have been around for some time. Some of them have been listed, if anything, in the UK since the 70s, and we know who it is. But there were also on the continent, like in France, in Belgium, and we know the names as well. The thing is, these were tools with very, very specific, unique features, and then they were fitting a very, very specific need. But now the toolbox starts to expand, notably, as I said, with Europe, with these new regulations. And so it's going to drive the market in terms of growth, but it doesn't necessarily mean that one tool is going to necessarily replace the other one. They will be more complementary. And maybe some of them will get refined, adjusted. There might be a boom in terms of innovation in that sense. And so I don't really think that there is a deep competition between these tools. It's really much more complementarity.
Do you have a view on where things might end up down the line with regards to the allocation to private markets in your average private wealth client's portfolio, or where you think it should end up?
First of all, to include private market, it has to be sufficient enough so that it can move the needle. So if you just put 1%, you could. Technically, you could. But is it worth the intellectual effort that we've been referring to or not? And if you just put 1%, what is it going to bring to you? Is it going to bring diversification, peace of mind? Is it going to really change the nature of your returns? Maybe not. I mean, it depends how it's done. And if you really find like the next gold mine, fine. But in a diversified way, it's very unlikely. We just published a memo on the dispersion of returns between direct investments, funds, and fund of funds. Yeah, technically, you could invest directly in the next Google or the next Facebook. The thing is, they're probably very unlikely to knock at your door. You need to be part of this ecosystem, this cluster, and you need to be recognized as such. And then this kind of opportunity is going to knock at your door. But otherwise, it's very, very unlikely. So 1% might be very small. By the way, that's more or less how much Swiss pension funds invest in the asset class. So I'm not criticizing anyone here. And maybe the Swiss pension funds have their reasons not to allocate more. It's a different topic. But what I'm trying to convey here is that it's not impossible, and it's not that it doesn't make sense at all. There might be logical arguments behind it. And then there will be a point where if the client allocates more, it will be much more challenging related to their, let's say, payout schedule, their requirement to have money to live and live for some of them very different lifestyles. So I would say above 10, 15, 20%, it's possible. It depends, for example, if you have income. Some of our clients still have core holdings in private firms that they built. They might have sold them partially or sold only some of them and they still have some, and then they don't really need payout. So then you can allocate more for the longer term, and then you can go beyond the 15, 20%. Or others would say, look, there is a point where I still need to be able to have some sort of flexibility. And so I wouldn't go above a certain threshold. If you look at the statistics, again, from the usual data sources, you will see that unconstrained investors, so namely family offices, high net worth individuals, endowments, foundations, and sovereign wealth funds, because they're unconstrained in terms of solvency ratios and regulations, they tend to allocate more to private markets than the more regulated universe, which is pension funds, insurance groups, and sometimes banks, but it's very rare. And this pool tend to be a little bit more cautious in terms of exposing themselves to private markets, because they want to control this notion of how much time will I need to get back my money, and then how am I going to steer the course? But these are the dimensions, and that's why the democratization is so complicated. To go back to one of your earlier questions, because we see that there are multiple dimensions, like multiple balls to juggle with, right? It's a complex complex topic.
Yeah, so I read your paper on the dispersion of returns. It was very good, and it laid out the concept very clearly. And I think, would I be right in saying that effectively it's, if you invest outside of a fund wrapper, it's very skewed, but if you invest in a fund, it's kind of a bell curve, and that's one of the things about the private equity structure. It's a great way of dealing with operational risk. So, for example, venture capital seems very risky, but in a venture capital fund, the risk of loss is much lower, which is why it could actually be much more suited to, say, pension fund portfolios than people might have at the first glance realize.
I think that's something that we regularly forget. Yes, we could do it ourselves because well, the fees get criticized very often in the industry. It's a big topic because you have management fee, performance fees, etc. So the fees get criticized. But the question is, if you do it yourself, can you do it much more cheaply and much more efficiently, and also with the same level of risk? And the answer is, it's possible, but probably not as cost effective. It's very simple. For a very long time, private markets were not really a topic. If you look at Shakespeare, The Merchant of Venice, it's a venture capital case, right? And of course, the play is wonderful, and there is an ethical dimension in it, which is the one that rightfully people remember. But at the core, it's a venture capital case. And it's fairly illustrative that at that time, if you were not a specialist of financing shipping, then maybe you shouldn't do the investment. And at that time, you didn't really have the notion of fund, and dedicated fund manager would know the shipping industry and then would be able to tell you, I'm going to select this captain because this and that, and I'm going to finance this approach because we need spices from this region, etc. So I think very regularly we forget we see that, the person next door can do an ETF with fairly low fees, which, by the way, started in the 70s. So it's not even that the ETF industry has been around for like 500 years, right? So there is also a process of evolution, and sometimes people get a little bit impatient, forgetting that it takes time, and an industry needs to evolve at its own pace. But long story short, I'm not here to try to sell a fund or a fund of fund. I'm trying to explain that there are some dimensions that we need to consider. And the reason why the industry has evolved in a certain way, it's also because somehow it became a kind of optimum. It doesn't mean that it's going to stay. Maybe we will find better solutions. But ultimately, so far, the venture fund has been one of the good ways to avoid losing 100% of your capital. It doesn't mean that it never happens. It's possible, but it's very, very unlikely. And still, with a fund, you have a chance to lose some of your capital, right? But it reduces the risk significantly.
What's your view on the private equity markets at the moment as we sit here in at the end of the first quarter of 2025 in terms of deals and exits and fundraising?
I think it's a bit of unusual situation. Normally, private markets tend to thrive when there are disruptions. Not necessarily in the middle of a storm, because 2008, for example, the buyout sector was active maybe at the smaller end, small buyout, smaller mid-market, but the large and mega buyouts were pretty much on hold. So in the middle of a storm, I wouldn't say that's not where the buyout world is the most active, but before or after, normally you have a lot of activity. I think the unusual situation at the moment is the uncertainties, and uncertainties usually last a certain amount of time, but after that we get over it, right? The uncertainties are related to the lack of equilibrium between buyers and sellers of assets. The problem is that the uncertainties have been around now for some time, and that's largely related to anticipations until very recently. So where is the course of interest rates going forward? Is it down? Is it stable? Is it slightly up or a little bit markedly higher up? And so the expectations between buyers and sellers had trouble to align, right? So some sellers might say, let's wait a bit because interest rate might go down and they would be supportive to the valuation of the assets we might want to sell. Whereas buyers might say, well, that's the right moment to buy because there is a business case to buy this specific asset at that moment. And so since they couldn't agree on the asset prices, there was a little bit of a subdued activity. Having said that, if we look at the evolution of the so-called dry powder, so the capital which is potentially available for fund managers to execute transactions and which are committed by the capital providers, the dry powder went down. So it means that the fund managers have been digging a bit in the piggy bank to do some deals. It's probably not as visible as we were used to when Hilton got private, when Dell Computers got private. So these kind of transactions are very visible, and then they give the idea that, oh, there is a lot going on. The playbook of the fund managers recently has been more like buy and build. So you buy an asset, which is not necessarily particularly big, might be, let's say, mid-market or upper mid, or maybe a little bit largish, but not to the point that you make the front page of the newspapers. And then you would aggregate to these assets, smaller assets. But this is not necessarily something which is thrilling or catching a lot of attention. But it consumes capital. And in particular, because smaller deals are less leverage by construction. So you need to put more of your own equity in it. And that's why probably the dry powder started to recede, because you still have a certain activity. But then fundraising, as your question alluded to, has been a little bit more challenging than usual. Most likely it was misinterpreted. The shrinking of fundraising is largely related to the reduction of attractiveness of venture capital for capital providers. But if you look at leverage buyout, it continued to collect quite a significant amount. So it didn't really shrink that much in terms of fundraising, a bit, but not that much. And to complement my answer to your very rich question, there is a challenge to find an equilibrium in terms of valuations. Maybe at the smaller end, it's easier. Capital providers put more equity on the table if we talk about leverage buyout now. And when they borrow essentially senior debt. You can say that the subordinated, convertible or not, somehow is at a very low point, to the point that in some markets it's more or less completely disappeared. And what you observe is that still today, there is some sort of constraint, which is that regulators in the US and in Europe said you shouldn't borrow more than 6 times EBITDA. So it means what? It means that probably the deals which are done today are a little bit less risky because there is more equity cushion involved. And the senior debt that you were referring to earlier is a little bit more accessible. So the cost of debt is probably more manageable as a package than if you embedded subordinated or subordinated convertible. And then you have this pressure not to do more than 6 times EBITDA in terms of leverage. So it means what? It means that going forward, probably the returns are going to be a little bit more constrained because well, if you reduce risk, then technically your returns are going to come up probably in, let's say, lower amount, lower, let's say, proportion than historically when you could borrow more and then your equity contribution would be lower.
That's fine. If risk is going down, then returns can go down. Do you think there's a relatively simple relationship between private equity returns over the medium and long term and interest rates? Do you think it's zero sum?
No, not completely. And that's a very valid point. And thank you for asking this question because sometimes people are dazzled by the leverage effect in leverage buyout. But if you look at academic literature, it's been documented that before the global financial crisis, and this is just an average with all the limits associated with it, but before the global financial crisis, 1/3 of the performance of leverage buyouts came from the leverage effect. After the global financial crisis, and that's an academic study which was published 2 years ago, it came down to 20%. So it's not only a matter of leverage. And so the value creation matters a lot. The buy and build playbook that I was referring to earlier, this playbook, for example, doesn't require a lot of leverage because, as we said, smaller assets anyway don't command such a high level of borrowing to be executed. But it means that the ability to merge, the ability to create synergies, to integrate seamlessly different corporate cultures, to make people work together, and eventually operate in a more effective way as a combined entity, that's a very specific skill set. And this is going to generate performance. The other additional effect, of course, is that if you buy at 4 times EBITDA and you successfully combine assets and you can sell them at 6 times EBITDA, for example, the multiple effect is going to contribute and be an integral part of your value creation thesis when you start to do the deals. So, in that sense, it's not as mechanic as it could appear on paper and theoretically, and that's why your question is so important, and that's why the answer has to be crafted in a nuanced way.
What advice would you have for young people, young professionals that are interested in getting into this side of finance, getting into private markets? What should they be thinking about and expecting?
That it became very fast a career path. When I started 25 years ago, we had very odd profiles like me, like other people coming in, and then it was much more like artisanal and much less industrial or industrialized. So today you have career paths. I think the profession will still need very diverse profiles, diverse in the sense of what did you do before you joined the industry of private markets? What kind of different perspective do you bring? I think the biggest challenge is to avoid these very normative career paths where we have blind spots and group thinking. It's one of the risks in the industry, because the industry needs to remain innovative and to find new playbooks, because once you have used one and on most of the companies, then the job is done, right? That's why today you cannot say it's a cost-cutting exercise. It can happen. It can happen still, but it's not the main playbook. Just like it's not an 80% debt and 20% equity playbook anymore. This is gone. So to have new playbooks, you need to have people who think about it, who had an experience and then can develop it and then can implement it. So in that sense, younger people shouldn't be afraid to try different things. I know it's easy said from my seat today now, but the reward will be probably that they will come up with different ideas, and then they will execute differently, and it's going to be much more interesting and enjoyable. The second thing is, if you really want to work in the industry, you should try to stay close to it. I think sometimes I see students and they have this very, very organized career plan. Like, I would do X years in an audit firm, and then I will transition out and do this, and then I will do an MBA, and then in 10 years I can work in private equity or more specifically private debt or private real assets. I think it's all great on paper. My modest experience is that unfortunately the world will get in the way. So when I started to work in August 2000, I didn't plan the dot-com bubble burst. It happened. And I didn't plan the global financial crisis. I certainly didn't plan the pandemic. I don't know who did, actually. Apparently some people could, good for them. But so what I'm trying to say is that if you're really interested, try to stay close to the industry from day one. It's not always easy, but actually you have an ecosystem now. And that's something which changed. When I started in 2000, the ecosystem of the venture industry was fairly limited. You had one dominant cluster and a few marginal ones, and the industry itself was somehow insulated and working on its own. Today, you have much more choice in terms of market participants you can work for. And if you cannot land your job in the industry, you can work at the contact of the industry while cultivating probably a little bit of this originality, right?
Yeah, it also seems to me that as the industry becomes more diverse and complex, there's a greater call for a wider variety of skills. So, for example, it's not just about being really whizzy with numbers. Like, you are a fantastic communicator, for example, and the industry needs some great communicators as it reaches out to different stakeholder groups.
That's one of the positive aspects of private markets, is that the human dimension is never far. For example, it's a big puzzle, right? Academic literature would tell you we are, at least some dominant threads of the academic literature will tell you we're very rational as individuals. So we know what is our interest and we try to maximize it. And that's how the world is running, right? And then you go in private markets and you realize it's not always the best offer which wins the deal. It's the most convincing one. It's the one which is supported by the most relatable individuals. And it's the one which usually is associated with a plan, which is going to lead the insiders, who will remain insiders, towards a certain milestone or a set of milestones within the next 3 to 5 years. So that's completely counterintuitive, because it means that someone somewhere left some money on the table, knowing it and voluntarily. And the trade-off is, I'd rather go for a non-financial outcome than maximizing my financial outcome. It's been documented partially by academic literature, which shows that in venture, very often entrepreneurs would select a very knowledgeable, established, and highly performing investor, but then accept a lower valuation for their startup, then shoot for the highest valuation, because for them, the immediate sacrifice is more than compensated by the midterm perspective that this kind of investor might contribute much more to their common success. That's counterintuitive with the framework that I was referring to. And that's why the human factor is still around. And if I can venture that, it would be great if it could stay around, because that's why the industry is so interesting and enjoyable.
Yeah, 100% agree. And if you take the efficient markets hypothesis at face value, you'll never understand that.
Yep.
Let me try and ask you a concluding question, and it's going to be quite a difficult one, which is, I've been thinking about, I'm a big fan of private markets, and I'd really like more people to invest in it because I think it would be good for them and good for the world. But I think one of the difficult things is, and one of the things that will make this happen is to somehow make private markets cool. That's what happened with Bitcoin. For whatever reason, it became cool. Let's say not cool so much as good for the world, right? You've got to convince people that what they're doing, I think, it has a real purpose, a real utility, perhaps beyond their own financial return. And I think that's a case that's, if it's been made, it hasn't been made well enough. It certainly hasn't captured the public imagination.
Yes, and I think that's a question we somehow have in the back of our mind, but it's never really the top question, in any debate or industry event that we're going. There is always a panel or a discussion, which is usually very interesting, but it's not really the top priority because there is this implicit idea that we still live in Adam Smith's world, right? Where if everything, gets sorted in a very logical and let's say self-conscious way, then the invisible hand is going to sort things out, and everything will be fine. To build the case, I don't know if we ever will make private markets cool. Maybe in the next generations they will know better. But there may be two things to consider. The first one is the split of the value created. If you share more with the people who were instrumental, notably the employees of the firms, and they see that on their bank account, it's going to be much more popular. People will talk and they will say, we had to work hard, but at the end of the day, it paid off. So, it's not a bad investment approach. It didn't hurt me. If anything, it helped me. So sharing eventually would be a good way to change the image. And so if you share with this wide range of individuals some of your performance, it's going to radically change the perception, of course. The second is probably, I would call it almost a medical approach. When you go to the doctor and then he or she says, you're going to have to go to check certain things, and we're going to do this to you and that to you, you assume that this procedure is for you to feel better or to get better or even solve a problem. And I think a lot of the perception of private equity is, there is this dark area and then they will do things to me and I'm scared, right? And if you don't see the ultimate goal and the fact that it might be curative or a way for the company to not only survive but thrive, then it's very scary. Of course, if you don't say a 3 years old that it's going to be anesthesia, but at the end they will be much, much better, they're going to be terrified. And I understand that. We need to explain also a little bit better, but systematically, not just say, trust us, we know what we're doing. You don't need to understand. This world is gone. Even in medical environment, you need to explain to the patient. Sometimes you need a little bit of their consent, and you will see that in some geographical areas, you need employees' information and sometimes employee consent. But this is an effort we need to do. We are not a cottage industry anymore. So we have more responsibilities. And one of them is simply to explain the things, the good, the more challenging, and that's how you build credibility, respect, and a little bit of transparency. So if you combine sharing the performance with a little bit more responsibility in terms of communication and education, then maybe it's not cool, but it's it's an improvement on the status quo.
Cyril, thanks so much for sharing your thoughts with us today.
Thank you very much for having me.
You've been listening to the Fund Shack podcast. Wherever you're listening or watching, please click follow or subscribe. That's all I ask. Thanks for listening.